Hi, it's Dre Griggs of Obsidian Wisdom. Today we answer the question, why is an emergency fund for retirement essential? When it comes to an emergency fund, you guys know I do believe that there's value in one. I just think that there's a certain way that we should structure it. And for me, I'm big on flexibility. I think as far as the interactions that I've had, that your ability to have flexibility, to be able to make a shift or zig when you wanted to zag as you get into retirement is very important. That is one of the best measures. And the reason that I've come to this conclusion is because for most of you, your freedom is how you measure happiness. Your freedom of time, your freedom of choice, your freedom of purpose, pleasure. You get to decide what you want to do. And as you get into retirement, believe you me, those things are going to change. There's going to be experiences you have, places that you want to go. You're going to be like, you know what? We had a great time when we vacationed and I want to live there. And you just like to have that flexibility. There's so many things that you can experience where you just want the flexibility. You want to be able to go back to school or you want to be able to move when a grandchild is born. There's so much value in you being able to control your time that I know that flexibility is important. If we're looking at an emergency fund from the flexibility perspective, I do think that it's something that's very valuable, very important in retirement. If we're looking at it more from the risk management perspective, then it really is a little bit of a mixed bag because we do know a couple things. First of all, we know that because of inflation, that we need to make 3% on average every year. Otherwise, we've lost money. And what I mean is if you're generating a 1% return and inflation is 3%, that means you lost 2% this year. So when I'm talking to a retiree that is very interested in having an emergency fund, I normally focus on having the 3 bucket withdrawal strategy. And you may say, well, Dre, what's the bucket withdrawal strategy? The idea of the buckets is you have some money that is set aside in short-term spending. This money is generally going to be in something that's relatively safe, something that's relatively conservative, and you give yourself 2 years of spending. I've seen it as short as 6 months, but it's normally going to be somewhere around 1 to 2 years. And the reason we do that, and you'll see with the other buckets, it gives you a little bit more flexibility. If you have 2 years of expenses set aside, then that means the money that's invested aggressively, you allow yourself to be able to ride some of those waves. Now, generally speaking, if you have your money invested in equities and other stocks, and maybe you were trying to figure out crypto and Bitcoin and things like that, you normally have to give yourself a 5-year window. That's normally going to be the average length of time where if I'm not touching this money for 5 years, it gives me the ability to ride some of these wins and losses. So if you have the 3 bucket strategy, then you already have 1 to 2 years of living expenses set aside in the conservative bucket. And in my second bucket or my medium term bucket, these are going to be things that I don't generally need to touch anywhere from 3 to 8 years. So maybe 5 years on average. I'm going to be focused on moderate growth, but definitely more focused on income in this bucket. And because I already have 2 years set aside, I know that I don't need to go into my moderate or my aggressive bucket because I've given myself at least 2 years. So if we have a recession, you guys know in the last recession, if I have my moderate and my aggressive investments maintaining, continuing to purchase investment, I'm now buying stocks on a discount. I'm now turning this recession into a huge opportunity for me to exponentially grow my investments. But the only way I can do that is if I have some sort of money that's outside of the general stock market so I can use that. Where if that is our emergency fund, then I do believe that that gives us a lot more flexibility and a lot more opportunities with our retirement investments. So normally inside of that moderate bucket, somewhere in that 3 to 8 year range, we're normally going to have our bond funds and individual bonds. So this could be municipal bonds, corporate bonds, or US treasuries. I'm going to be focused on dividend paying stocks or equity income funds. And then I'm going to have preferred stocks, which is the stocks that if you are going to pay a dividend, I get the dividend first. And then I'll also have some balanced mutual funds. So these normally are going to be designed in a way where we're not really focused on growth funds. We're focused on companies that have already shown us they're successful. The thing about investing in growth is we are taking a little bit of risk because more times than not, we're projecting what that company is going to do. And you and I, we don't actually know what the company's going to do. Sure, we can get a lot of data. Sure, we can read a lot of reports. Sure, we can have a pretty confident feeling, but we don't actually know what that company is going to do. But when you're investing in a balanced mutual fund, generally speaking, these are companies that have already won. So we're not investing in them because we hope they grow by 10% next year. We're investing in them because they just grew by 5% last year and they've grown by 5% the past 10 years. So we're investing in a company that has already shown us what it's going to do. And as a result, we're taking much less risk and we don't need as much runway to prepare for such an opportunity. And then inside of your moderate, you'll also have any income annuities that you're going to be generating income off of. All of this is inside of that moderate bucket. And then when you move into that third bucket, your aggressive bucket, this is where we're still swinging for the fences, where we're allowing ourselves the opportunity to take advantage of some of these funds, where we're going to be investing in broad-based index fund, growth-oriented mutual funds and ETFs, international and emerging markets, real estate investment trusts, REITs, and alternative investments. All of these would be inside of that long-term bucket, which is generally going to be 10 years plus. And because of the way we design the other buckets, what we're basically doing is we're giving ourselves a 10-year runway to where we're able to say, now my aggressive investments have been performing very well. I'm going to rebalance my portfolio, and I'll put a link to another video where I discuss rebalancing. And now I'm going to move some of those wins. I'm going to sell some of those stocks, but I'm not going to buy it back in my aggressive bucket. I'm going to buy it in my moderate bucket. So I'm now taking my most aggressive investments and moving them into my moderate bucket. And then when my moderate bucket, every so often, I'm going to sell from that bucket and move it into my normal emergency fund, my 2 years of living expenses. As a result, you've now given yourself, anytime the stock market goes bad, you give yourself 2 years to make that money back, where I can just live off of my most conservative bucket. And it gives me multiple years to allow my other investments to replenish. So I gave myself 2 years for moderate investments to come back, which they should. They're moderate, safe investments, a lot of bonds, annuities, and different things. So I'm going to have that income still coming in. And as that works, I'm going to work that down. And then if I need to, my aggressive bucket, I can go 5 years without touching it. Now, generally speaking, the market doesn't need 5 years to recover, but you design your withdrawals in a way that you could. And that's what we're really going for. And so when you talk about having an emergency fund, the number one benefit of an emergency fund, in my opinion, is it gives you the ability to protect your investments to ensure that you don't run out of money in retirement. Now, because we have 2 years set aside, we also have the flexibility in case an emergency does pop up. If I have extra healthcare expenses, I have 2 years of living expenses set aside. Hopefully, any sort of healthcare expense isn't more than 2 years of your retirement budget. But now, if you do have something where you need a surgery or you have to see a specialist or you have an event that's not covered, you have the money that you now can set aside. And then, as we mentioned, you would then just bring the income from the other buckets to replenish the funds as you need it. It's also important to note that one of the additional benefits of having more flexibility is the fact that you have less stress. Because I know that I have a lot of moving pieces, that if something happens in the stock market, I know that I don't have to take that loss. I don't have to take the money out of there. If I have something happen in any of my buckets, I know that I've given myself at least 5 years. And again, on average, that's more than enough time for us to ride out any recession. I mean, even if you think of the last one with COVID, you only needed about a year, maybe 2 years to really get that money back. If you have this fund, where you have your emergency fund where it's 2 years that you don't have to touch the money, and then you allow the rest of your money to replenish, as you've seen what happens after every recession, we have significant gains. Now, sometimes it's because whatever caused the recession, we fix it. Other times it's because the government spends money and kind of props it up. But either way, you do not have to sell your investments during the low times. Another nice benefit of having an emergency fund is you now get to avoid having to take on extra debt. You don't have to refinance your house and take out a mortgage. You don't have to go use credit cards because you have 2 years of living expenses set aside. So now you don't have to worry about these high interest credit cards, these high interest loans, and these debts on your different assets. Because the issue about taking on debt is twofold. One is my money's not working as efficiently because I have to pay back this interest on these loans. You and I both know that compounding interest can work for us and it can work against us. It works for us in the stock market, where you put money in and then it grows and it continues growing and then the growth grows and it just is a snowball. But it's the opposite when compounding interest works against us with some of these loans, where we pay the balance, but then the interest charged on a daily basis covers most of the payment. So then it's like just my balance is going down a little bit because I'm just paying the interest. So you don't want the debt because it allocates your money less efficiently. but then you also don't want the debt because now it raises your cost of living. Where maybe your retirement was $50,000 a year, well, maybe if you have to pay $2,000 a year in extra debt, well, now your lifestyle is $52,000 a year. And you can see how that could spiral someone into having to take out more loans and more debt because they're trying to maintain this lifestyle. And as the lifestyle keeps going up, it makes it that much more difficult for us to be able to maintain our retirement lifestyle overall. And I don't want you to have to decrease your lifestyle to get out of debt. Ideally, we're able to use this 2-year runway of our emergency fund in a way that allows you to be able to use those funds, and then you pay yourself back from your other 2 buckets, as we mentioned. And then from there, you're able to replenish it, and then you don't have to worry about it. You don't have the additional expenses that you have to pay on an ongoing basis. And then you also have your money still operating in the most efficient and effective manner. So as you can see, an emergency fund protects you from life's little surprises. It gives you peace of mind and control over your finances and unexpected expenses in a way that gives you the comfort of knowing that you'll be okay in retirement. If you have any additional questions for me, I'm always here. You can reach out to me, ask me in the comments, or shoot me a message. You can go to obsidianwisdom.com to learn more. Until next time, stay safe and enjoy life.